Hello everyone and welcome back. In this video we are going to talk about the latest portfolio updates from three quality investors. Dave Cantesaria from Valley Forge Capital Management, Pat Dorsey from Dorsey Asset Management, and the team from Akre Capital Management. The name here is Chuck Akre, but he retired, so that's his team. Anyway, these are three quality funds, and in this video I want to comment on the latest updates. So what they have sold, what they have bought, because I believe quality investing is at a turnaround position in 2026. All the quality stocks are going down right now, so you have to make a tough decision. Either you pivot or you double down, and it will be extremely interesting for all quality investors in the world to see what these guys are doing, because these are the ones to follow. Okay, these are the most expert investors I know when it comes to quality investing. So of course you want to monitor what they're doing, what they are buying, what they are selling, what they are saying in their letter. So obviously very important, and I want to talk about all their picks in this video. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm a quality investor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in quality companies. And the goal with this YouTube channel is to help you become a better investor. So of course, Dave Cantesaria from Valley Forge Capital is a very interesting investor to follow. I've been following him for almost a decade, and the first position he has right now is Fair Isaac, FICO. He bought FICO in 2018, and over the past couple of quarters, he trimmed a little bit, added a little bit, trimmed a little bit, added a little bit, trimmed a little bit, and now he's adding a little bit more. What you can see for the latest update for the Q4 2025, so between October and December 2025, is nothing. He just took a little bit of profits, trimmed a little bit his Intuit position, and reallocated the funds with FICO, S&P Global, MasterCard, Visa, etc., etc., etc. So no meaningful changes for Dave Cantesaria. The only move is this: a small reduction is in Intuit. That's it. The way to look at these 13F documents, the portfolio updates, is to look at signal and to differentiate between signal and noise. A move, an addition of 0.2% of his portfolio is not meaningful enough to note it. It means absolutely nothing. It's just that if you are a fund manager, you have inflows of capital, so you have to reallocate some funds. So maybe he got more inflows, more investors, so he decided to reallocate, to reshuffle his deck a little bit. So it means trimming a little bit of Intuit and reallocating a little bit everywhere. So the only move here is a reduction in Intuit. Intuit, in case you don't know this company, they have a couple of brands, tax reports, TurboTax, MailChimp. It's a company, a quality company with a wide moat, and it's an accounting software that helps you with your tax reports. And now the stock is down massively because there is a worry that it will get automated thanks to AI. There is a worry that AI will replace Intuit. People will use AI to make their own accounting, to make their own tax reports. But if you look at the business, revenue is up and to the right, net income is up and to the right, free cash flow up and to the right, life is good, you have debt, but that's okay. It's just that the business fell off, not because of main worries. The stock is going down because of valuation. In the past, you had a forward PE ratio of 40, 30 for this business. If you are trading at this premium valuation, so it's a premium business, it deserves a premium valuation. If you have a worry and your business model is in danger, just in case, people freak out and people sell. So the forward PE ratio went from 30 to now 16, cut in half. The stock is now at a pretty cheap valuation comparatively to the quality of the business model. So now that we know this, when was Dev Contessaria selling? We said this report was between October and December. So October and December, he sold before the big drop. Now, the thing to monitor is, let me show you the stock price. Stock price between January 2025 and right now. Okay, so he sold before the big drop. It will be very interesting to see what Dev Contessaria does in the next quarter. Is he buying more? He sold before the drop, so maybe a lucky timing. Maybe he knew something beforehand. Maybe he saw some signs. The drawdown since he sold is minus 40%. As I'm recording this video, Intuit is down 40% year to date. A brutal move. And he trimmed a little bit, 15%, before this decline. It will be extremely interesting to see if he doubles his position now that the stock has dropped, cut in half. Next question, I've received some comments. Will I touch Intuit? I don't like Intuit. I will not invest in this one. The mode of the business is good, but they are not focused on their shareholders. You have a few yellow flags when it comes to Intuit that I dislike. So, for example, they want to grow 20% per year, and the only way they can grow 20% per year is to make a huge acquisition. And you can check the earnings report and their slides. They are aiming for a 20% growth rate in revenue. Organically, it's not feasible. So the only way they can grow 20%, so reaching their goals, I mean, you can look at their slides, it's public and free, is to make an acquisition. They have to make an acquisition. They have to take on more debt to make an acquisition. They have to dilute shareholders to make this acquisition. And I don't like this at all. I don't want to be invested in companies that desperately need an acquisition to grow and reach their goals. So for this reason, I'm out, and I don't care if the price is cheap now. I see other opportunities that are cheap enough. So it's a good quality stock, good quality company, but maybe out of all this SaaSpocalypse, all the software companies that are going down, maybe you can find better opportunities that fit your style. For me, I want to invest in companies that are doing buybacks. Intuit is not doing buybacks, and Intuit is almost guaranteed to do the reverse of buyback, to dilute shareholders. So only for these reasons, I'm out. So the valuation right now is extremely cheap, actually. Forward P ratio of 16. If you look at all the companies in the SaaSpocalypse, Intuit is hated at the moment. We are back to prices seen in 2022. Really looking forward to seeing if he adds more to his position in 2026. And out of all the redistribution of all the cards, you can see that the biggest addition, if you can note it, is MSCI. Well, that's so minimal that we are talking about 2%. So it's kind of irrelevant, but we will see. We'll see in the future if he does something else. You can see that he is not famous for doing a lot of moves. You can look at the activity, not a lot of moves. It's not the first time he's trimming Intuit. He sold a little bit of Intuit in 2025, in 2024, last quarter, in Q2, in Q1, in Q3. It's not the first time. It seems like he wants to get out of Intuit. So I don't know if the price drop will force him to buy more. Now that all the software stocks are down, maybe it will seize this opportunity to completely trim Intuit and buy something else that is going down. You have many software companies that are going down. I mean, if you want to look at moat companies, Salesforce is a good example that maybe has a better moat compared to Intuit. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. The second fund we are going to talk about today is Dorsey Asset Management. Pat Dorsey is famous for only investing in companies with a wide moat. So you can look at all his holdings, beautiful companies with a wide moat. He has built his track record based on this. And what are the moves? You can see that he has trimmed a lot of things, a lot of red, and he has bought only 2 things. So, first of all, he added more ASML. Now that ASML is at an all-time high, he is adding more to his position. Strong conviction in ASML, and that fits his investment style because ASML is a monopoly. The stock price has gone up so much, it has become his first position. And really interesting to see that he is still having a lot of conviction in ASML, plus 11%. He did not touch the Danaher, that is resurrecting at the moment. Aircap Holdings, so leasing aircrafts, not touching his position, a little bit of a trimming, but 3% is irrelevant. He trimmed a little bit of Meta. That's interesting because Meta at the time was his core position. He trimmed 15% of his Meta platform's position, and he trimmed 50% of Google. He wants out. He trimmed because he is seeing better risk-reward opportunities. This is not the only investor who is trimming this big capex spender. You can look at Google, look at the activity, ownership activity, and look at what we have. Plenty of super investors are now trimming Google. Quality investors. Seth Klarman trimmed Google by half. Pat Dorsey trimmed Google by half. You have plenty. Bill Ackman is trimming the other share of Google. You have 2 classes, Class A, Class C of Google. Plenty of quality investors that are out. Bill Ackman trimmed, Altarock trimmed, Wedgwood Partners trimmed. So maybe they see better opportunities. Pat Dorsey is reducing his exposure to Google and Meta platforms, and it is reallocating the fund to ASML and Live Nation. Live Nation is a very interesting company that I have not spent a lot of time on actually, because the business model is quite new for me. But in case you want to get more exposure in this ticket industry, entertainment industry, we are a beautiful ecosystem. We have a beautiful ecosystem for Live Nation. He's not the only investor touching it. The ecosystem, the flywheel is strong, but it's not perfect. So they are diluting shareholders every year. The business model is consumer driven. They have some debt apparently, and the valuation is stretched. So the analysis is quite tricky for me to analyze Live Nation. I don't think I will touch it, but always interesting to just monitor what he's doing. After this, he is still holding Bookings Holdings that just reported beautiful earnings report, by the way. The earnings report from Bookings, pretty good. A Royalty Pharma investment, not touching it again. He trimmed AutoZone and he trimmed Enovis. So an overall plenty of trimming actually. You look at Pat Dorsey, only 2 buys. The rest is trimming. No new buys. He's not buying into the SaaSpocalypse stocks. And again, we will see in 2026 if he is buying some software companies that are down 30-40% year to date. It will be very interesting. So it's really good to see their portfolio at the end of 2025 and compare it to the, middle of 2026. I suspect you will have plenty of changes during this 6 months period, and it will be quite intense for them. It's a quite intense period for them. So yeah, Pat Dorsey for the moment, reducing his exposure to the Magnificent Seven companies, reducing his exposure to Google massively, trimming AutoZone, trimming Meta, and buying more ASML and Live Nation, which is new. Okay, third fund I want to talk about, fund created by Chuck Akre, Akre Capital Management, and the fund is famous for holding quality companies and holding them for the long term. So, of course, the biggest position stays MasterCard. Of course, the second position stays Brookfield. Then you have KKR, so a competitor to Brookfield, and Visa. So that tells you everything you need to know about the fund. It's about buying and holding, and you do nothing. So you have a little bit of trimming to fund the acquisitions, but the biggest positions stay the same. MasterCard is 20% of the portfolio. Brookfield and KKR, roughly speaking, that's 24% of his portfolio. Visa is 10%. I mean, the portfolio is very, very concentrated. Moody's is 10% of the portfolio. What is funny is he has trimmed Moody's 18%. And since then, at the beginning of 2026, Moody's is down. Moody's is down massively. So again, you want to see if during the next quarter, Q1 2026, he is buying more. But he sold a little bit of Moody's to buy some things, to buy more CoStar. Oh my God, CoStar got demolished at the beginning of 2026. Again, plenty of software companies going down. He trimmed O'Reilly a little bit. He trimmed Roper, but a tiny bit. Didn't touch Airbnb. He bought more FICO. He bought more Copart. He bought more CCC. And now we are talking about small companies. They want to get out of American Tower. And they completely trimmed out of Danaher. They completely sold off. Okay, wonderful. Next one on the list. Do you have this? No. They completely sold out of Verisk, but it was 0.02% of the portfolio. So, they trimmed their winners, like MasterCard, Brookfield, a little bit, Moody's a little bit, to fund new purchases, notably FICO and Copart. It's not the first time they are doing this. A couple of quarters ago, last quarter, Q3 2025, they were again buying more FICO, more Copart. Last quarter, Q2 2025, they were buying FICO and Copart. So it seems like they have found new opportunities. And since then, since their buys, FICO is still down. I can show you. FICO is still down, doing nothing. So they can maybe buy more. And Copart is going down again. They reported earnings a few days ago as I'm recording this video. The earnings were bad, but the management resumed buybacks. The management started buybacks again. And when the management is doing buybacks, most of the time they are right. Most of the time it means they are cheap. They are timing their buybacks in a very, very smart way. So now Copart, in case you don't know Copart, it's an online salvage vehicle auction company. Okay? So they operate almost in a duopoly niche market, and they are famous for growing conservatively. You look at the revenue up and to the right, net income up and to the right, everything is smooth. They have zero debt, they have $5 billion of cash, and they don't do buybacks often. Last time they did some buybacks was in 2019. And now Copart just announced a $500 million buyback program already done. So it seems like the management thinks they are cheap. If you look at Copart, I can show you the buyback program. The stock has dropped significantly. The stock price went from 60 to now 30. The forward PE ratio went from 40 to 20. So everything got cut in half because the report was bad, because revenue is declining right now. You can look at the quarterly data. This is your revenue growth rate. for the first time since COVID, the revenue is down. The revenue is not decelerating, the revenue is declining, -3%, as you can see at the right of the screen. So maybe the business is in a bad period, the stock is down, the business is declining, revenue is down 3%, but the net income is down 9%. So yeah, the fundamentals are declining, but the management team is saying it's only temporary. We are doing buybacks. Don't worry, guys. We got you. We are using the cheapness of our stock to do buybacks. Look at this. Look at this. The chart you are looking at, all the candles, this is the amount of buybacks they are doing. When this candle is negative, so down, it means buybacks. And you see here at the right, you have $100 million of buybacks for the quarter. But actually, during the call, they said something. Yeah. It's a tweet from Bourbon Capital. Between November and January 2026, the company repurchased $200 million worth of stocks. I don't know why it doesn't match. But anyway, you will understand. During the call, Copart said, in addition, during the second quarter, so in 2026, we began to repurchase shares and we have an aggregate amount of buybacks of $500 million. So please be careful if you use websites, investing websites like Fiscal AI, because you want to update for the earnings calls. If they are repurchasing $500 million of shares, maybe this is their biggest buyback ever. So the management team is really bullish for their stock price. They really think the stock is cheap at the moment. So you can check the earnings call here on Fiscal AI. If you want to use Fiscal AI, you can use my link in the description and use it completely for free for 2 weeks. No credit card, just click the link in the description and register. It's very easy, very simple to use, and I really recommend you use this website so you can have this report here. Okay, so we talked about the buybacks. Okay, it's the first time in 6 years, 7 years, that the management is doing buybacks. And the last time they did buybacks, well, it was a pretty good time to buy the stock actually. The stock was down, and they, look at this. 2019, here we go, 2019. Don't doubt this management team. I think they know pretty well what they are doing. Every time you bought the stock when they were doing buybacks, it was a very, very good time to make a profit. So I will monitor what is happening with Copart. I'm not a fan of their business model. It's too hard for me, but I will monitor what is happening. Because the stock is dropping massively and the business is declining at the moment. Okay. So they added more Copart, they doubled their position, and they added more to FICO. FICO, I understand. I bought more FICO for my own portfolio actually. And apart from this, is it. So very recently, we learned that this fund, Akre Capital Management, bought ServiceNow and Salesforce. So new additions in 2026. So we start to see some motion in this SaaSpocalypse, that quality investors are buying the dip in quality software stocks. Very interesting, and we will see this during the next 13F, Q1 2025. So we will see if, for example, they buy Intuit in the next quarter, or if Dev Cantesaria, the other fund, Valley Forge, is selling more Intuit and buying ServiceNow or Salesforce. Really, really intrigued to see what will happen in 2026, because now is the opportunity to buy the dip. You have so much hate, so much pessimism priced in for software stocks. If you were hesitating to buy, I mean, why wait? The hate and the disappointment and the panic we are seeing right now for software companies is immense. So it seems like Akre Capital Management, this investment team, is buying the dip. And maybe if these stocks continue to go down, which can happen, they will double down on their position. They have to double down. They have to take a lot of risks. I have released a video a couple of weeks ago about this fund in particular, and they were sharing their performance, outperforming the market. But because they were hit so badly because quality stocks went down in 2025, their outperformance shrank, which means they are now on par with the S&P 500 for the past 5 years, 10 years. So it's a very important year for them. 2026 is maybe the most important year for them of the decade. It's that important. They have to make bold bets and they have to be right. And the best thing they are doing right now, the best decisions after thousands of hours of research, is to buy ServiceNow and Salesforce. So they have a lot of conviction to buy the dip in this SaaSpocalypse. It tells you everything you need to know. Now these are starting positions, right? They will continue to buy the dip, I think, as these stocks are going down. Maybe they will increase their exposure in the future. I'm really looking forward to seeing what will happen during 2026. I think they will buy the dip and they will continue to buy more, increase their exposure to all these hated names. And I would not be surprised if they trim some of their winners like Brookfield or MasterCard to buy heavily discounted stocks like these software companies. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.